Else here, and in this video we'll be exploring the statement of changes in equity under IFRS. First, let's remind ourselves of the proper order of the financial statements. The income statement comes first. The profit or loss at the bottom of the statement, which is a measure of a company's performance, is the opening number in the statement of comprehensive income. This statement then adds or deducts unrealized gains or losses to provide a broader definition of profit or loss, one that includes both realized and unrealized amounts. The unrealized gains or losses on the statement of comprehensive income are then transferred to the statement of changes in equity. Companies following IFRS must prepare a statement of changes in equity, which reports how profits, dividends, shares, and other items have affected shareholders' equity. Information from this statement helps users watch and assess equity so they can make decisions about financing. In order to understand the statement of changes in equity, we must first understand what makes up the element equity. Equity is made up of two or more items. We'll cover the three most common and save the others for future videos. Share capital represents the amount of cash, goods, or services a company received in exchange for a company's shares. The most common form of equity is when shares are sold to the public in exchange for cash. This is called a direct investment by the shareholders because the shareholders choose to invest directly in the company by buying the shares of the company. Shareholders indirectly contribute capital when the company decides to retain profit instead of paying it out to the shareholders in the form of dividends. This indirect investment is called retained earnings. Retained earnings is increased by profit and decreased by dividends paid out to shareholders as well as losses from the income statement. The amount of retained earnings represents all past profits kept in the business to help a company grow, less all past dividends paid as well as losses. Another item in equity is accumulated other comprehensive income. This is the total of all unrealized gains and losses from the statement of comprehensive income since the company began. This amount is increased by unrealized gains and decreased by unrealized losses. Now that we understand the items that make up the equity element, let's take a look at the structure of the statement of changes in equity. As always, the statement starts with the heading, which must include the company name, the title of the financial statement, and the time period covered. Notice that the statement is set up in columns, starting with shares and ending with a total column. The order of the columns must be the same as the order of these items as they are listed on the Statement of Financial Position under the Shareholders' Equity section. The body of the statement always starts with the beginning balances. These beginning balances are the closing balances from the prior year's statement. Next, items that impact the different columns are added or deducted. Let's look at each column individually so we can better understand which items must be taken into account. First, let's focus on the share capital column. Here we denote it as common shares. The beginning balance comes from the prior year's statement of changes in equity. Notice that the only things that impact share capital are the transactions that cause share capital to change. Here, the issue of shares and the repurchase of shares. This makes sense because we are trying to show users details of what caused share capital to change over a period of time. The closing balance for the current year will be transferred to the Statement of Financial Position. Next, we'll look at the retained earnings column. Again, opening balances come from the prior year's Statement of Changes in Equity, and closing balance are transferred to the Statement of Financial Position. Where does the profit for the year come from? Well, the profit or loss on the income statement is added or deducted from the opening retained earnings. Here we took the profit of $17,100 from the income statement and added it to the opening retained earnings from the prior year. We also deducted the dividends declared or paid to shareholders because they represent a payout of profit to the shareholders. Next, we look at the accumulated other comprehensive income column. The opening balance again comes from the prior year's closing balance on the Statement of Changes in Equity. Then, the unrealized gains and losses that were detailed on the Statement of Comprehensive Income are added or deducted from the opening balance to obtain the closing balance. It is very important to notice that the actual amount of other comprehensive income, the amount at the bottom of the Statement of Comprehensive Income, never shows up on the Statement of Changes in Equity. To see this clearly, let's quickly flip back to the Statement of Comprehensive Income, which we covered in a previous video. Notice that the total comprehensive income amount is $18,200. This number never shows up in the Statement of Changes in Equity. In fact, it never shows up anywhere else. Instead, only the individual amounts of the unrealized gains and losses are transferred to the Statement of Changes in Equity under the Accumulated Other Comprehensive Income column. These individual amounts are the ones transferred to the Statement of Changes in Equity. It's important to remember this when you develop the statement. Going back to the statement of changes in equity in its entirety, we can see that at the bottom of the statement, we have all the amounts that will be transferred to the shareholders' equity section of the statement of financial position. Pause the video to answer the check your understanding question. What would be the company's ending retained earnings given the amounts provided? A is incorrect because it includes the gain from revaluing investments, and this item belongs only in the accumulated other comprehensive income column. C is incorrect because it includes the issue of shares, which belongs only in the share capital column. D is incorrect because it includes all the numbers given. B is the correct answer because it includes only the opening retained earnings plus the revenue, less the dividends paid, and less the expenses. There are many uses for the statement of changes in equity, but right now we'll focus only on the information from the retained earnings column and how it is used. Investors use information about retained earnings to predict future dividend payouts. They also use it to see if the company is retaining enough profit for future expansion. Lenders use it to determine if dividend payouts are appropriate and leave enough cash for debt repayment. Other creditors use retained earnings information to see if the company is investing profit back into the company for future expansion or growth. As you already know, the statement of changes in equity is connected to the shareholders' equity section of the statement of financial position, which is the topic for our next video.